Good evening to all those in the audience, judges, and members of the CFA Society. We are Team 2 from the University of Minnesota-Duluth, and today we are ecstatic to present our recommendation and analysis of the company at the forefront of creating a cleaner, safer, and healthier world, Tenant. My name is Jack, and alongside me are my partners Lucas, Ben, and Sam. We are initiating a hold recommendation on Tenant with a 12-month price target of $78, representing 2% downside from current levels. Our recommendation and analysis are supported through Tenant's leadership position within the industry, management's ability to execute on current strategic plans and pillars, and the company's strong financial position. We believe that Tenant is a fundamentally strong company and is currently fairly valued, limiting it to a hold recommendation. I will now turn it over to Lucas for an in-depth overview of Tenant Company.
Headquartered in Minneapolis, Minnesota, Tenant is an industry-leading manufacturer of industrial and commercial floor cleaning equipment. It operates through 4 business segments, which are equipment, parts and consumables, service and other, and specialty coatings. The company primarily focuses on its product and service offerings, where we feel they have a distinct competitive advantage. Tenant operates globally through its private label brand, as well as through 2 of its holding companies, IPC and Gaume. In 2017, Tenant acquired IPC, increasing its revenue in the EMEA region to 27% of sales. IPC focuses on customers in the mid-tier market, where it sells its products at an average 20% discount to Tenant's premium products. Tenant's other holding company, Gaume, is a Chinese manufacturer which targets companies transitioning from mop and bucket to power floor cleaning machines. Gaume looks to sell its products at an average 40 to 60% discount to Tenant's premium products in the Asia-Pacific region. Transitioning to our industry overview, Tenant operates in the janitorial equipment and supply industry, selling to customers in end markets in education, retail, healthcare, manufacturing, as well as many others. Due to the nature of this business, the industry is highly sensitive towards customers' decision-makings on capital expenditures, which is why we feel the industry will continue to grow at a 1% CAGR moving forward. Key players within this space include Nilfisk, Karcher, Hakko, and Toski. We've identified Nilfisk as Tenant's closest competitor. All these companies are differentiated to their product and service offerings. Key trends within this space include the consolidation of product offerings, as well as the transition towards autonomous technology, forcing companies to focus on their core competencies. Furthermore, Brain Corp has partnered with many key players within this space as they look to implement their autonomous technology into their products. Let's now transition to our first catalyst, Tenant's leadership position. Tenant is the industry leader within its estimated $5 billion industry, boasting a 20% market share, a full 2% above its closest competitor, Nilfisk. We believe that Tenant is dominant to Nilfisk due to its extensive service plans, broad service network, and strong financial positioning.
When comparing Tenant to Nilfisk, we believe Tenant clearly dominates Nilfisk. Both firms have a target R&D as a percent of sales at 3%. And as you can see, Nilfisk fails to reach their target every year, while Tenant is consistent of hitting their target of 3 to 4%. This spending is used to drive innovation, helping secure major customer contracts such as Walmart. Tenant's leadership position can also be seen through its interest coverage ratio of 3.4 times compared to Nilfisk's 0.6 times, illustrating Nilfisk struggles to repay its debt. Tenant's ratio changed dramatically in 2017 due to the IPC acquisition, but we project this ratio to normalize going into the future. This trend continues with comparing Tenant's days inventory on hand of 88 compared to Nilfisk's 111, which shows Tenant's ability to effectively move its premium products. Tenant's also the clear leader when comparing the 2 companies' margins. Tenant's always had higher gross margins than Nilfisk, showing it can maintain its premium price and its effective cost management. Tenant also has higher net margins than Nilfisk, other than the year 2017, when margins were unfavorably impacted due to the IPC acquisition. Now let's take a look at the management team's ability to execute on the company's strategic plan. Tenant is led by CEO Chris Kielenstedt, who has been with the company for 17 years. His vast experience in manufacturing and international business has helped him lead Tenant in his tenure at the company. Also leading Tenant is CFO Keith Woodward, who recently joined Tenant in 2018 after a 26-year stretch for General Mills, where he served as Senior Vice President and other finance-related roles. Both executives' compensation are tied directly to long-term organic revenue growth and short-term EBITDA expansion, which reflects the company's strategic plan. We believe Mr. Kielenstedt and Mr. Woodward will effectively execute on the company's 3 strategic pillars, These pillars include winning where Tenant has a competitive advantage, seen through the discontinuation of lower margin product lines. Also, the reduction of complexity in the creation of scalable processes, seen through the reduced number of machine configurations offered. And lastly, innovating for profitable growth, which will be driven by the implementation of autonomous technology. Now let's take a look at Tenant's position financially. Tenant is well positioned financially, as the company has undergone significant deleveraging, increasing its interest coverage ratio through the rapid repayment of debt. This repayment of debt has been made possible through increasing profitability. We project EBITDA margin to expand 133 basis points, which will lead to increased cash flows to $100 million by 2024. We believe these strong cash flows will be used to deliver shareholder value through the continuation of dividend payments and the re-implementation of Tenant's share repurchase program.
Historically, Tenant has used its cash for dividend payments, share repurchases, and capital expenditures. Following the IPC acquisition in 2017, Tenant shifted its focus towards debt repayment, repaying nearly $100 million in 2017 alone. Going forward, we believe that Tenant will shift its focus towards capital expenditures and returning value to shareholders. These capital expenditures will help Tenant maintain its industry-leading position within the emerging autonomous technology market. Now, on to valuation. We believe Tenant is fairly valued, as future margin expansion and growth are aggressively priced into the stock. To value Tenant, we conducted a discounted cash flow valuation due to the consistency and stability of Tenant's cash flow generation. Key assumptions that we used in our model include a WACC of 7.4% and a terminal growth rate of 2.5%. Other key inputs into our model are a short-term sales growth rate of 3.5% and a long-term sales growth rate of 3%. We also chose to model a decrease in SG&A as a percentage of sales from 31.5% to 29.7%, reflecting our belief of management's execution on current strategic pillars. Finally, we also chose to model a decrease in cost of goods sold from 54.5% to 53.5%, as we believe Tenant will discontinue lower margin product lines, leading to further margin expansion. Next, we conducted a sensitivity analysis due to the underlying sensitivity of discounted cash flow valuations. To accomplish this, we performed a 10,000 draw Monte Carlo simulation of WACC. This produced an average price of $79, a median price of $78, and had a standard deviation of $9. We also chose to conduct a two-way table analysis of WACC to short-term sales growth rates. This produced a range of $75 to $80. Finally, we confirmed our discounted cash flow valuation by conducting a valuation by multiples. We used an EV to EBITDA of 12.5 times and an EBIT of $145 million, which led us to a price of $82. This confirmed our intrinsic valuation. Jack, can you now tell us about Tenant's risks?
Of course. We believe the key risk lies with the implementation of the autonomous cleaning technology. Should Tenant fail to transition customers to this technology, they will experience slower than expected growth moving forward. The next risk that we have identified is management's potential inability to not execute on strategic plans. If management focuses on short-term EBITDA expansion that drives compensation benefits at the expense of long-term growth, such as tripping unnecessary product lines, we feel this could damage the business. The third risk that we have identified are employment conditions. Tenant's labor force is made up of higher salaried employees, many of whom engineers and innovators, which can cause stress on the company's margins. If Tenant is unable to attract and retain top talent, they will struggle to continue innovating their products. And the last risk that we have identified is foreign exchange risk. Tenant has faced increasing foreign exchange risk due to their strategic expansion into international markets, where significant fluctuations in these currencies could unfavorably impact the company's bottom line if not hedged properly. In conclusion, we would like to reiterate our hold recommendation on Tenant with a 12-month price target of $78, representing 2% downside from current levels. We would like to thank all those in the audience and the judges for coming out tonight, and we would now like to open up the floor to any questions.
So you mentioned that products and services are a competitive advantage for Tenant. I think you touched on the products with the autonomous innovation, but could you talk a little bit about how services are a competitive advantage?
Sure. Can you hear me? We believe Tenant has has a competitive advantage to its services due to the extensive service network that it has compared to its competitors. So as you can see, Tenant has 7 service plans compared to NILF's 4 service plans. And we believe these plans are more extensive, and the service technicians are allowed Tenant to have that competitive advantage, as well as Tenant's service technicians are usually Tenant factory certified, and other competitors in the industry they're a third party that service out. So we believe that's why they have a competitive advantage in their service network.
Okay, so you have 3.5% for the near to midterm growth, sales growth in your model, right? So can you talk, I mean, of course, if you look into the last quarter, they have 6 to 7% in the Americas, but like 4% down in EMEA and the Asia Pacific market. So can you talk about the puts and takes there in each region? So, you know, what was the drivers in each region, and then why you think 3.5 is the best mix here?
We chose a 3.5% rate to reflect our short-term expectations, which go up to 2024. For this first year in our model, we have it modeled in the middle of management's guidance between 1.5% to 2.5%. So it is lower than the 3.5% that you see, but that 3.5% number is for our short-term view guidance until 2024.
Sure, but can you talk a little bit about geographical dynamics here? I mean, American market, Asia Pacific, EMEA.
Yeah, for our discounted cash flow model, we did not break it out geographically. We actually chose to break it out by all their different business segments, so parts and consumables, service, and their equipment segments, and we went that route, and we did not break it out geographically.
I wonder if you can sort of walk through your expectations for margins for the future and why.
We're projecting further margin expansion across all margins, from operating margin to net margin. Operating margin expansion is going to be driven by the efficiencies created when Tenant discontinues lower margin product lines. That will lead to reduced cost of goods sold initially, which will help their operating margin expand. And then we see net margins expanding as they repay debt and they have lower interest expense.
Just a follow-up, so you had, I guess, a slide before that you're talking about the IPC business and the Galme business. Those margins, I think, there were 20% discount on the IPC and then 40 to 60 on the Galme. So just to kind of get a sense as to kind of what the company's planning to do with margins in those business and kind of what that would do for overall margins for the company.
Just due to the market where these products are sold, in the Americas it's a much more established and rich market than it is in Europe and especially in China. So we feel that IPC and Galme need to sell these products at a little bit of a discount to be able to enter into these new markets. And once they become more mature, we see them more or less being in line with Tenant's premium products.
Thank you.
So to the valuation question, you incorporated EV to EBITDA and you came up with the 12.5, but can you walk me through how you got to that number?
You're wondering how we came to the EV to EBITDA number?
Yes.
Okay, for that, we looked at what they've historically traded at on a next 12 months basis and what the operating conditions and environment were like for them to command that multiple. And right now we're seeing that they're expanding margins faster than they have historically, and so they'll command a higher multiple at the higher end of their range, which has historically been between 10 to 12 times. So that's how we arrived at that, because they have more margin expansion than they have historically, combined with steady growth rates.
You didn't include it in your presentation, but can you tell me what the margin difference is between service and equipment?
We did not find any information on that. They did not break that out.
Thank you.
You had talked about different ways that they allocated capital across, like you said, CapEx, debt reduction, and dividend, I believe. And your expectation is that they will, I believe your quote was, return value to shareholders, but you didn't actually say how you see them doing that.
Yeah, we see Tenant returning value to shareholders through dividends in the short term, and then further in the future, they will resume their share repurchase program because they are now below their debt covenants levels. So for the short term, we just have dividends continued.
So can I assume then that you guys believe that dividends is a good use of capital?
Yeah, for a mature company like Tenant, we believe a dividend payment is a great return to shareholder value. I believe we said our cash flows will increase to about $100 million. Most of that will be through interest expense and repayment of debt, but the rest of that will be through dividends. And then once they repay their debt down even further, we believe they'll pick up on that repurchase of shareholder or stock outstanding.
So if you guys were going to advise the management team between, let's say, either increasing their dividend, doing a special dividend, or doing a stock buyback, how would you advise them?
Could you repeat the question, please?
So they can return cash to shareholders a couple different ways, right? They're already doing a dividend, so they could increase it as one way. They could do a stock buyback, or they could do a special dividend. And so my question to you guys is, you're in front of the board, you're going to advise them on the best way you think they should return cash to shareholders. How would you advise the board?
Yeah, so they increase their dividend by about $0.01 every year. So I would say that they could continue to increase their dividend payments, return shareholder value that way. And then with everything left over, we would say they should repurchase their shares outstanding, increasing the size of the pie that the shareholders have, which would be a good way of returning shareholder value.
So today is different than January 15th. What do you see as the new risk and new potential for this company in light of the coronavirus?
Yeah, so management for Tenant believes that the coronavirus is actually an opportunity for the company. For one, in China, infrastructure is increasing to 4% spending annually, and they will, management believes that the cleaning standards will have to increase as well, increasing their opportunity to make a bigger presence in China. So coronavirus would be an opportunity in that sense. The headwinds would be facing further industrial headwinds that they could face.
Just on top of that too, in the short term, we could see a slowdown in the capital expenditures that certain companies make towards cleaning equipment, like Tenant Company has. But however, as we've highlighted moving forward, it is an opportunity as these cleaning standards are raised in different areas of the world, and it presents more opportunity for Tenant to further penetrate these markets.
I guess I just can you guys clarify, you said you think they have a dominant market position, and yet the market share is only 2% gap, which to me doesn't warrant dominant, both in absolute terms and the difference between them and number two. So could you just clarify when you guys say dominant, what do you mean?
Well, when we look at Tenant's closest competitor, Nilfisk, they're facing major headwinds in all the markets that Tenant operates in as well. And Tenant's seen increase in revenues other than the EMEA region, where Nilfisk has a stronger presence. But Nilfisk is seeing decreasing organic revenue growth in many of the regions that Tenant operates in. So that's why we would say they have a dominant position in those markets.
Did you look at the market share change through time between these two?
We did look at the market share change through time, and Tenant has increased their market share recently because of their positive organic growth that they've had, where Nilfisk has had negative organic growth and has forecasted negative organic growth in the future. And then just to touch on the previous question you had about their leadership position, see margins.